at MI2 Advisors. Hey, Julian, it's great to have you on the show.
Thank you, Maggie. Lovely to see you again.
Yeah, good to end the week with you. We need some energy on what has been an exhausting week. I mean, what a week. Trump wins the US election, the Fed cuts rates again, stocks off to the races. The Dow gets above 44,000, S&P above 6,000, small caps ripping, crypto ripping, the dollar stronger. Can this last?
I mean, it can. Yeah, I mean, it definitely can last. I mean, I think a lot of it has to do with, typically we have this sort of year-end run, right? Into equity. So we'll see. I'm a little skeptical this year that it runs with such gusto, but we will see. I think, I think what we've done is the market was drifting towards the Trump victory. So we had sort of the long dollar, long stock, short bond trade on roughly. And we don't have to go into why those were, but those were kind of the trades that everyone assumed were sort of Trumpian trades. And we can run with those until we run out of positioning, short-term positioning. And I think you could see some signs maybe in the FX market and fixed income that's already sort of beginning to kind of happen. Then I think we have to wait for confirmation that our assumptions are correct, Maggie, right? That what we think was going to happen is actually starting to happen. So how would you see that? Well, Trump's supposed to be very pro-growth. That's why the equity market's running up to some degree. Deregulation is another element, obviously. And we should start to see that probably sometime in the next month or so as some of the data starts to kind of, certainly that sentiment-y kind of data starts to pick up, right? And that everyone will go, oh, look, growth's great, everything's fine. And then I think early next year, as we start to get all the appointments, I don't think they've really truly formulated the nuts and bolts of the policies, what I understand from my mates in DC. And, it's more than they did in Trump 1.0, because that was a total surprise. They had nothing ready. Yeah. But I think, when it comes to really grinding out the nuts and bolts of what, and a lot of those things are very important to how they impact markets. I don't know whether that's necessarily agreed. But I think as we move into next year, I think this market is in for a bit of a challenge. And I say that because I think there's an assumption that all Trump wants is booming corporate profits and a rallying equity market. And don't get me wrong, I think those things are very important to him. But that was not the constituency that elected him. He wasn't elected by Wall Street. They might have funded him, right? But he didn't elect him. What elected him were the workers of the United States. And I think people misunderstand Trump 1.0 because, in a way, some of his legislation, some of the aims that he wanted to achieve were polluted by Congress and lobbyists. And it didn't turn out the way that tax bill wasn't the tax bill that he wanted. And so I think this time, certainly with the incorporation of tariffs, he has a chance to achieve this. Now, what he wants to achieve is physically bring production back into the US, right? So everyone assumes that's great for corporate profits, but what you're doing is you're forcing America, through corporate America, right? The most profitable companies who've absolutely taken every Harvard, Yale, MBA and maximized their, global production to minimize their cost, and forcing them through a bloody great stick of tariffs to move production back to the US. Now, that might be great for workers in the US, not probably ideal for corporate profitability, right? And by the way, I'm pretty sure he's going to single you out and castigate you if you don't, right? So I think this gets really quite interesting. And then the second thing I think is we have to understand that there are real bits of the economy away from the S&P 500. Right? We look at the S&P 500 and go, oh, everything's great, everything's booming. But if, on the other hand, small businesses are paying, which they are now, 10, 11% for their funding because bond yields have risen, not fallen, and the mortgage costs you 8, not 6, or God forbid 9, right? That there's actually a real economy that relies on that, on that. And all of a sudden they start not working as well and start downsizing, right? Because that's where we were. I think we forget we brought this employment market, which slowed it down really quite a long way. We hadn't seen the layoffs, but there were very few hirings. We cut down on overtime. We pushed people onto part-time work. We'd done all of the things that were typically pre-recessionary. Mm-hmm. And maybe Trump has delayed that. But if we don't get those rate cuts, is that enough, Maggie? Right? Or do we find ourselves early next year going, oh, wow, where's the unemployment number? Right? You know, what's happened to mortgage applications? Where's home building going? Right? Yeah. Because the stuff that Trump wants to achieve, I think it's in many respects commendable, but it's going to take years. Years, right? You can't just shift your production overnight from China to back to Illinois or Indiana or wherever the heck you want to put it, right? It takes time.
Yeah. And as you say, there's a price, and Christopher pointing that out. Hi, everybody in the chat. It's Friday. We made it. Pointing that out as well, right? They have a plan, but there will be pain and there'll be costs. And this was this big shift I think you're talking about from capital to labor. So I guess the question is, but of course, in a campaign, no one ever talks about cost, right? You know, like that's.
We'll worry about that. You get a car, right?
Yeah, everybody. But is there an environment where growth is strong enough, and that profits or companies can offset? There's an offset to the fact that they're going to have to pay a lot more in terms of workers, especially if there's a transition to that. What if there's this promise of deregulation, of lower corporate taxes? Like, are there other goodies that Trump can trade in order for the worker to benefit too? Like, can both?
Yes, there is, and in one word, it's called productivity. If you can boost productivity, you can grow the global pie. And this is the daydream. I'll put it politely. I was going to think of a different type of dream. This is the daydream of the.
We knew you were going to be a little bit naughty somewhere, Julian. There's like an active bet going on.
Yeah, exactly.
In the chat to see whether you can resist.
I'll try. So this is a sort of daydream or the pipe dream of the equity analysts, right? Who say this is 1995 again, right? This is what we do. We're standing on the cusp of this. Sort of run up in corporate profitability that looks like the late 90s, with the building out back then of the PC and the internet, or the coming together, let's say, of the PC and the internet. And this is what AI is going to do. I think, sure, it's possible. I would point out that the PE of the S&P back then was like 13. It's 24 or whatever it is now, right? So slightly more difficult. Unemployment was 6. We were just coming out of recession. So we had a lot more labor to kind of suck into the economy as we re-accelerated growth. But conceptually, yes, if you get productivity, this is true. So does deregulation do it? It could, Maggie. I do think, though, when I look at this, and this is when I put my old person's hat on, when I look at the US economy today, right, it isn't a US economy that, let's say, in the 80s or the late 70s that we had in the UK under Margaret Thatcher, right, or Reagan, which was really stifled by tons and tons of bureaucracy and red tape, certainly not at a federal level, right? So I don't know how much Trump can do at a federal level to really change things, because the problem really is the states. And I'm not sure that dynamic is really going to change that much. So I'm not sure it happens during deregulation. I kind of hope that they're right and we kind of get it. Is it going to be through AI? Yeah, I mean, at some point it definitely will be. But is it this year, coming year? Because if it isn't this coming year, and this equity market rips and, spending kicks off again and the Fed doesn't cut, are we just going to go right back to this game that we played for the last 2 or 3 years, Maggie, where the equity market rips, the bond market goes, oh, they're doing it because they're going to cut rates. Wait a second, and we're moving into recession. Oh, wait a second, we're not moving into recession. Oh my God, I sell off again and yields spike again. And what saved us every time, Maggie, because remember, we thought it looked like manufacturing was going to recession in 2022. It looked like the whole economy was sliding at the end of 2023. And every time we managed to pull it back and we pull it back and pull it back. And one of the things that has enabled us to do this is everyone locked in their funding for long periods of time, right? It was a very unusual period because typically in a recession, you kind of get a window of like 9 months if you're really good to lock in that super low mortgage rate, to refi, right? To lock in your corporate loans. And most people aren't that good. They don't do it, right? This time we had 0 interest rates for a long time. And if you didn't lock your funding in 2020 and 2021, you're a bloody idiot, right? But most of that funding's 5 years-ish. So it's coming up.
Yes.
Right? So I loved it that like a few months ago, we were like, commercial real estate is back. Woohoo! Here we go. Here we go. Really? Look at where your funding rates are today, because bond yields have gone up, not down, despite the Fed cutting. So that real economy, I think, Maggie, gets harder and harder to keep punting that inevitable correction unless we get something truly miraculous, like real Goldilocks kind of stuff, right? That productivity, golden ticket, get out of jail free card, where you growth can run really hot for a long time, but inflation doesn't rise and people's wages go up and more employment, right? It's bloody hard to do that.
Yeah. And I just had a conversation, which we'll release, folks, on Sunday with Michael Howell, who was talking about the wall of refinancing that's coming. And
Right.
it's huge. And there are so many implications from that. And as we know, Michael is this expert on global liquidity, really fascinating stuff. But so yes, that is an issue that everyone's going to be facing, but the Trump administration is going to face as well. We have a question while we're on this from L Big UU. Maggie, could you please ask Julian what his thoughts are in long dated bonds? Thanks. So against that backdrop, Julian, what do you see happening with bonds? Because they have not been following the Fed's lead. They've kind of stabilized a little bit here at the end of the week, but we saw a big spike. We saw a big spike in the MOVE index, which measures volatility in the bond market. I think it got up to 130, catching people, raising some alarm bells. What are you expecting from bonds?
So first, I'm going to share a screen, Maggie. I'm going to give you some chart porn, right?
Okay, let's go. Let's do chart.
Let's do it. So share screen, window. There you go. So this is my long-term view on bonds, right? So this is total returns on treasury. So this is including the coupon versus spot gold. So 0 interest rate asset. This is horrible, Maggie. They are an instrument of confiscation, right? Gold has outperformed since 2000. And when you look at this trend line here, it looks like we've blown through 35 years worth of support. And because this is locked, these are...
Okay, and we're looking at that top purple line, I think, right?
Yeah, this top purple line here. And these lines, because this is a log chart, these are a lot lower, right? So I just don't like owning bonds, right? I think you can trade them, but I keep having this rant in the office where I say you can't own them. And then when you look at, say, the futures market, which is really the long end. So if you look at the technical chart of the 30-year future, you can see this just cascading lower, right? Now, if you're a technician, we just broke this and your target's down here. That's new highs in long-term bond yields, right? So now they've bounced, but I think we have to ask ourselves, why did they bounce? And they bounced, Maggie, because the Fed was pretty hawkish in their hike, right?
In their cut, you mean?
In their cut, sorry, yes. So And I think that appeased some of the bondholders, because the reason why these things are going down is because the market's getting increasingly concerned that we're going to have rapid growth over Trump, which could be inflationary, because I'm certainly one of these people who do not believe that inflation which is dead, right? And what was more worrying is the Fed seemed to be cutting aggressively, so they weren't going to protect the value of that future income stream, so those bonds. So you had to demand, more coupon to own those things. And I think that's what's been going on. That, and the fact that I think there's a shrinking pool of global savings available to buy those bonds, but we're not going there today. And so I just think, in a short answer, trade them, do not own them.
We have another question that's related to this, and then I want to ask you about something. Melson is saying, is Jay Powell more likely to see how easy financial conditions actually are, despite what he's been saying for the past year, now that Trump won? Would love to hear your take on this. I also think when I first started reading it, it was like, okay, we had a big rally in equities, the Fed's cutting, is this just making their job harder? Yes. Or are we going to see them continue to cut? Like they're just going to.
So it's an interesting question. So you're saying, you're asking, is the Fed political, right?
I think that's what Melson's asking.
Yeah, I think that's what he's asking. And I can tell you that I've got lots and lots of friends within that policy sort of circle who talk to policymakers all the time. And one of them at the beginning of the year said to me, and it's one of the guys I most respect in this space, who does talk to policy officials, he said, a recession is not an option in 2024 because there's an institutional fear of the orange man. And I said, no, you're joking. Come on, no. We got to the end of 2024 and we haven't had a recession. And we haven't slowed the economy down, and we don't have rising unemployment. So I want to believe, Maggie, that the reason that the Fed is cutting is because, a bit like me, they're a little bit more worried about the labor market than they let on, because I think there are some definitive cracks. Like I just said, I think we've walked the labor market up to the very edge. The tippy toes are hanging over the edge, right? If Harris had gone in, we'd have gone right over, do not pass go, straight into a recession ultimately, because you'd have killed animal spirits. This way, I think there's a chance that we step back. But do I expect the Fed to come out and be really sort of hawkish now under a Trump? I don't, I'll be honest with you. And the reason why is, the other reason I don't want to believe this is that I can just believe that the Fed is just crap at forecasting the economy. Right. I have this very good friend who set up the first policy think tank for Tudor in DC. Great individual. And he has a favorite saying where he said, I followed the Fed man and boy for 50 years. They're most bullish at the top and they've never caught a turn. So I just want to think that the reason why they're now slowing from what they thought was, they're slowing their rate cutting likely, was that they thought the economy was really dangerous and it was going into recession, and they just got it wrong, right? They just got it wrong again, right? Just like they did it, at the end of last year, where, oh no, we can pivot, we're all going, oh shit, no, look, it's all taken off again, right?
Yeah. Yeah, well, and certainly that's probably gotten, that calculation is going to get even more tricky now that we don't have a real line of sight on what was a campaign promise and what will actually get through, even though it appears that Republicans are going to have both houses of Congress, although we have to wait on that. Yeah. I want to, in regard to that, and this is something that another issue for the Fed, I want to ask you about bond vigilantes. They've been coming up a lot. And one of the things that is an issue with this is that, people weren't around. A lot of people, a lot of investors, individual investors listening to this, a lot of traders were not around when this was an issue. Does that worry you that we are in a regime possibly where people just don't have experience with bond volatility, with things like bond vigilantes. Is that a concern? Like, are people operating thinking that the same rules apply as they always have? Like, do we have what we need to kind of figure out? These are really complicated cross currents.
I mean, this is something that, I like to pride myself in sort of going back and looking at history, and we have a rather frightening 200 plus years of collective experience in the direct team that helped me sort of put together the MI2 product. I think, look, first thing I would say, Maggie, is are the bond vigilantes back? And the answer is no, not really, really not. As I said, I think what's really been driving bond yields is an increasing concern about a reacceleration of growth, right? And to some degree, just a lack of attractiveness of fixed income. Like, yields are not really at levels that are compensating. There's, equities are doing far better. Why would you have your money?
So it's not. If it was a bond vigilante, we'd know it. Is what you're saying?
I think if
it would be a much more dramatic
signs in the market, for example, something that's a bit overly technical, but called term risk premium, where you'd be seeing that start to rise. So in other words, the bond market would be truly asking for, in the same way that an insurance company does, greater premium because the risk is really materially rising. And that's what kind of term risk premium measures, and that is not happening. I mean, it's risen, but it's still basically zero, right? You want to see term risk premium, then term risk premium during Volcker's terms hit 5%. So just what bond investors wanted for taking the risk, right, was an additional 5% on yields in the early 80s. Now, when I look at the world, I do see a world that could end up there. I've always said this on Macro Insiders, MI2, that if I connect the dots, I do see a world that could increasingly look like, I think it looks like the late 60s. We're not yet in the 70s, that leads to the inflation. But when I look at the world, I don't see an inflation that's been cured, right? Look at what the Reserve Bank of Australia said this week, right? Look at what the Bank of England said this week. These guys are beginning to realize that this hasn't been solved. I do think that this assumption that many, many people have, that next year they're just going to, rates are coming down, everything's going to be fine, is a bloody fallacy. And that we haven't taken any of the pain because, as we discussed before, we haven't had to refinance the debt. Well, that's going to start to happen. So those risks are all rising. And I think that historical perspective that, I've seen this game before, right? I mean, it is always a little different, but I've seen this froth in 2000. I saw it in the GFC. I was sitting on desks back then. I have colleagues that saw it in 87. And it is this uncontrolled lottery, casino mentality, which you can see every single day. And it's exacerbated by, I saw this. I was up in Canada at a conference, speaking at a conference the other day, and I met this young kid, and he trades Canadian regional bonds, right? And he's a young kid, a nice young kid, chatting away to him. And I said, so, well, what are all your mates going? He goes, oh, they just trade US equities. And I was like, they're in Canada and they're trading US equities? He goes, yeah, that's all they do all day. They just sit online on their phone and they don't know what they're trading, but they're just trading momentum. Okay. But if that isn't a casino, I don't know what is, right?
Yeah, it's hard though, right? I mean, so Ralph is asking, what's the best macro trade that you see right now on the board? Ralph's an experienced trader. For those of you, investor, I would say. For those who are in the chat, know that. But for the average Joe, like it's easy to get sucked into the casino, Julian.
Yeah, and look, the casino.
I see it all over Twitter, X, social
TikTok,
media.
and I mean,
TikTok, how to be a millionaire in 3 days.
Well, how to be a millionaire in 3 days.
Yeah. So
and look, a lot of people have made some great money. I mean, you do have to realize that until it's in your bank account in cash, you haven't made it, right? Just because it sits on the screen as a number, it isn't actually real, right? So what's the best macro trade at the moment? I think these, like I said before, I think these trends in the sort of bond yields up slightly, probably equities, let's see how much further they've got to go. Currencies, I think that initial wave is probably over, this sort of Trump euphoria. I think a bit more of the money that we typically see in a year-end rally has been sucked in than we might think. But we'll see. And price action is really very important. So I don't know whether there's a great macro trade until we really get into the beginning of next year. I think these trades are quite stretched. You know, I could say, look, I think the euro goes from here to 103. Whoopee shit, right? You know, really? 4 big figures? Well, who cares, right? I mean, so it's a little hard. It's a little hard right here to come up with a, you know, after these massive, great big runs.
Well, sometimes the best trade is no trade.
Right. To come up with these great macro trades. I think, frankly, as I look at the world, I think this is, you know, we're launching the new product, and I've said on a couple of videos, I do think this is one of the most interesting times in macro. Now that means there's potentially great profits, but frequently macro does well when there's potentially great risk, right? Macro, I've got a very good German friend of mine, and he goes, "Oh yes, Julian, you know, your best day is when it is raining, but not when it is raining vertically, when it is raining horizontally, so there is no way of staying dry," right? And what he means is macro guys love blood in the street, right? That's what we do. We're really important at the bottom of the market and at the top of the market, and kind of in the middle, we have stories, and like everyone, but we're not stock pickers, so we're not picking something that's cheap, right? You know, you can trade certain things, but really when we come into our own is at those inflection points. And we're not really at one. I think we might be approaching one.
And that's going to be really important. What do you mean new product? What are you talking about?
Oh, so we've launched this new thing. So, you know, we were doing Macro Insiders with Raoul for a long, long time, this sort of retail product. And for a long time, we've sort of been diverging in the things that we focus on, right? Raoul's sort of gone off and done a lot of things on the crypto space and done incredibly well in that side. And we've just sort of stayed true to what we do, which is macro, right? I don't really get involved in picking bloody altcoins and all that sort of shit, right? It's like I don't pick individual stocks. I look at macroeconomic trends, and I'm trying to, trade off the back of that. And so we've decided to sort of go our separate ways, and we're launching as a result our own retail focused product. So it's going to be called MacroCapture, and it launches kind of this coming week. If you sign up now on the MI2 website, mi2partners.com, you'll get the first drop of stuff next week, and we'll talk about what we think is the biggest, the biggest by far trade that is dominating all markets, and we'll walk you through the mechanics of what you need to watch. And I'm not saying it's ending tomorrow, but we'll run you through that. But yeah, so this is a product that we've been kind of working on for a while, and the sort of idea is relatively simple, Maggie. We want to try and simplify what is a pretty complex. You interview a lot of macro guys.
And a lot of people have gotten it wrong.
Right. We all look at different things. Right. We're going to try and break that down for people and make it sort of accessible so that, it helps you in your day-to-day decision-making process and your risk. And really, a lot of it is risk management, right? It is, I want to help you make money, but I want to protect your portfolio at that time, right?
Yeah.
At that time.
Do you think we're going to be in an environment of increased volatility? Does it seem?
Definitively, Maggie, definitively, right? We've been writing about this for a few years, that if you go back and you look at we've lived in this period since from the mid 80s to sort of, let's call it the COVID and maybe even the GFC, COVID, of what we call the Great Moderation, where sort of rates were going one way, everything was fine. The central banks patted themselves on the back for doing such a bloody great big job. And then when inflation broke out in the 2020s, I think we're going to this period of what we've referred to as accelerative oscillations, where you get these cycles in markets which are increasingly volatile, right? And the amplitudes of the cycle becomes increasingly dangerous. And yes, we think we're in that sort of environment. So I think steering your way through that and managing your risk and your portfolio and your family wealth is really, really important. So we want to try and help people do that. Part of that is going to be an education process where we sort of, try and walk you through some of these more complicated ideas, right?
Yeah. So let me ask you a question, Julian, because this is really interesting. We're having an active conversation in the chat. I feel like, especially as we turn into the new year, looking at everything that passed, I feel like a lot of the people at macro, I mentioned that it's been a tough macro environment.
Yeah.
And so some people have been doing some kind of, inventory is probably the word I'm looking for. And so I talked to David Rosie, who's been a bond bull for a long time, who was like, you know what? There are things I got wrong. I'm really thinking about this and I'm feeling uncomfortable. I'm cautious. And this was before anything happened. I talked to Ed Yardeni, who's a stock bull, who was like, I'm a stock bull, but I'm a little nervous about these bond vigilantes. You have been, I wouldn't say a bear. I don't know how you categorize yourself, but you have been skeptical of equity rallies. And, there's been a lot of gains. And anybody who wasn't totally bullish on NVIDIA or who took profits, Dan Druckenmiller's in that camp, lots of people, right? There's lots of that. Are you rethinking anything? Do you think that you were too bearish on equities? How are you reconciling?
So, I mean, if I look at, as I said, my job is really not to pick individual stocks, but I would say, yeah, there have been times when I've been concerned about the equity rally. But I mean, when I look at my own portfolio and I look at the trades that we've been recommending, the big ones that we've been in are precious metals.
Right.
I feel much, much more comfortable in precious metals than I do in equities. I think, don't get me wrong, I think if equities were to drop 30% tomorrow, I wouldn't be up in my precious metals, I'd be down. Yeah. But I would be down relatively small. I think there are much stronger hands and there are much more structural underpinning to the gold story in particular than certainly the equity story.
So you're comfortable with your viewpoint?
Yeah, look, I mean, I think there's actually a mechanical process, Maggie. What really worries me is I think there's really a mechanical process. And, Mike Green talks about it in terms of indexation, right? But I think, I think there's really a bigger macro mechanical process that's running behind the scenes that has to do with this sucking in money into the US. And that can go on for a while. It's very powerful. But when we've seen this before and it didn't end well, it ended really badly, like really, really badly. And I look at this and, as I said, if I look at my, I do have stocks, don't get me wrong, right? We have a company pension plan. It's a very tax efficient way to run a small business, right? And we have a lot of stocks in that, right? We have a lot of stocks in that. But I also have PA, much more of my wealth away from that.
Yeah. Yeah. I mean, it's just, this is conversation we're all having, diversification. I would also say, Rumi, one thing that people have pointed out is that, and I talked to Andy Constant about this, there's like your long-term positioning and preservation of wealth, and then
Yes.
short-term speculative account that everybody has and plays with. And maybe you invest in stocks, or maybe you're the Canadian guys in US equities, maybe you're on FanDuel, and maybe you're sports betting. We don't know. But there's a difference between those two things. And that's another big consideration. And sometimes when we're throwing around these conversations, and this is why I think it's important when you have a lot of experience like you do, to have that long-term view. You know, you don't want to confuse the two. You want to know.
No. Thanks for pointing it out, Maggie, because you're absolutely right. Look, I mean, I put that chart of treasuries against gold up there, and I said, you know, these are things not to own.
Yeah.
Well, I would trade them if I think it got to the right point, right? If I thought, you know, we got to yields at 485 again, and I thought they could fall back down to 420, sure as hell I'd be long bonds, right?
Yeah. No, that's so true. I have to ask this question because it came at the very front. I'm a little bit worried, actually. I think this has been an exhausting week for everybody because Ringo, the nicest beetle, put a poll up that said, everybody expecting to have a good weekend or a fun weekend. And like only 52% of you said, yes, it's going to be a fun one. Like what's happening with everyone else? We're just too tired? I'm worried. Okay. Mudashir asked at the very beginning, Maggie, can you ask Julian that I know he's not into crypto, but after the Trump win, where do you see crypto in a 6-month time horizon with M2 growing?
So, look, I think like a lot of these risk assets, it's doing kind of well, right? I mean, it's performed. It was interesting. There was a period where it looked like gold was going to actually break out against crypto, and it was down to some kind of long-term trend lines. And I was tempted even to buy some crypto, I will say, on a relative basis, but I can't do it.
Wait, Tony Greer just told me he wants laser eyes and he wants people to make his avatar. He's like, you know, he's a momentum guy.
Tony's in and out of trades even quicker than I am, Maggie, right? Yes. I mean, I can't keep up with bloody Tony. So, you know, look, I think this breakup above, let's call it, firstly, just sort of the downward wedge we were in around 71,000. I think that's kind of important. The break above, call it the upper 73,000s. As long as we kind of hold those levels, I think you're probably all right. But the thing that certainly the move today convinced, the last few days convinced me, this really crypto is just a high beta, balls to the wall, long risk trade. Right? It is not a differentiator. It is not a store of wealth. I know, Raul, I just don't believe it ever will.
Well,
I think
that's an open. He's not the only one. There are people who are.
Why I think it ultimately, if the world that I fear we're going to, it won't be a store of wealth. But I also don't believe per se it's really a Trump trade, right? I mean, I'm sorry. I think Donald Trump said everything to get elected. They all do. They're politicians, right? Like we said at the beginning, you get a TV and you get a TV and you get a TV. So all of a sudden, here's a guy who's crapped on crypto for ages, right? Goes to a dinner where they pay him $1 million, and all of a sudden, I love crypto, right? Come
You're
on.
skeptical. I'm going to color you skeptical on that.
Yeah, I'm a bit skeptical. I mean, just look, I think it's doing well because risk is doing well, and like all risks, you should be run, you know, close stops on it. I think things are getting quite stretched, and we're at an interesting inflection point. We're either just going to blow through all these things and go parabolic, in which case, hang on for the ride, right? But remember. Like, you know, you and I were around when we were trying to persuade Raul in that first blow off in crypto. Like, maybe, mate, you should be thinking about taking some profits.
Well, which any commodity person worth their, you know, worth their weight would tell you that anytime anything's parabolic, be nimble and take profits. Yeah, right? It doesn't matter what it is. It's not specific.
You know, back in 2021, I remember the show, and I've got great respect for Raul, right? But you know, I think he got carried away in his own euphoria. And I said to him, mate, this just looks like a classic bubble, right? You know, shouldn't you be locking in some profits, right? So I think, don't get me wrong, I think it can run, but if it's running with, crypto's running with everything else.
I'm going to give you the last word on gold. Before I do that, though, I think Akash, I'm going to give you, we don't even have time to talk about this, but I think you get the prize of the day for the best question, because Akash asks, will the bond market be the force that enforces austerity on the government? That is such an interesting question. And I just had this conversation with Michael Howell. So I'll let you answer that after gold, Julian, if you want to weigh in on that. But Akash, go listen to, when it posts on Sunday, my conversation with Michael Howell. He has some really, really interesting things to say about that. And, you know, stuff that I think nobody in the market's really paying attention to right now. Okay, Julian, first gold, and then you can weigh in on bond as an austerity handcuff if you want.
So look, we've been very, very long gold for a long, long time. And in the trading stuff, we've kind of taken profit. It's reached a lot of the levels that we wanted to reach, those sort of upper 2000s. You know, in my primary holdings, I just own, and I keep saying, you know, it goes back to what you said, Maggie, different time frames. I've said to people, no, I just want to own it, right? I just want to own it, right? I don't want to sell it. But within the trading recommendations we make within MI2, and we'll make within the new product, we would probably recommend you take some profit kind of here.
Yeah. Well, sticking true to what you said about anything that's going up, right? Look to lock in some profits as you go. And then I don't have time. Ralph really wants to talk to you about Brexit. I feel like that's like an hour on its own.
No,
yeah. Okay. Ralph, we'll tackle it next time.
Yeah, look, I can answer it. It was a fucking disaster, and I can tell you, I think it was a fucking disaster, and I can explain to you why I think it was. It was just the wrong time, right? A little country that's, you know, open, you know, very international, goes on its own. It's great to do it when you're just at the beginning of a wave of globalization and free trade. We picked the absolute arse high to get out on the globalization trade, and we're going now into big pack politics, you know, big boy blocks of things, and it's just going to be a little country, which I'm afraid is not good.
Is tough in those spheres of influence. Yeah. It's amazing. I'm so glad you're coming out. MacroCapture, right? Is that the name of the new product? I'm so glad you're coming out with it. I do feel like so many of the conversations I've been having, this threads through so much, and these big geopolitical changes, if you haven't watched D. Smith, go watch it, that are coming. The big issues with debt, the big questions about bond. These are all big macro topics that it feels like not just the big players, but individual investors are really going to have to pay attention to, because they have these far-reaching effects on everything. And it's not just sort of, you know, you could just bomb it in the S&P and forget about it. It doesn't feel like we're in that environment anymore.
No, I really, look, I wish it were that simple. Look, I'm not just tooting my horns. I think we could be entering a period which I think is really quite destructive, really quite dangerous. And you know, in that respect, I think, you know, some of the things that Raoul said about, you know, you've got 5 years to kind of get your shit together are kind of right. I think, you know, do it in different ways from him. But I do think this is going to be a very, very financially dangerous and challenging environment.
Yeah. Or at least one where we really have to pay attention.
You really have to. Look, I think, with that challenge, Maggie, comes opportunity, right? Yeah. That's, as I said, you know, when the rain is going sideways and most people can't stay dry, that's when the macro guys come out and play. And I do think we're in that kind of environment. And look, I ask any of the listeners or the viewers on this thing to truly ask themselves, right? When they look around and they look at this, is this sustainable? Right? Do they really feel in their gut that the next 5 years looks like the last 5 years? Now, if they do, great, fine. Don't bother to follow us, right? But if you start to say, I don't know, right? I don't think we can do this, right? I don't, you know, right? If you get those feelings, that's macro talking to you in the gut.
Yeah. And even politically, you know, if we're going to see the workers have more, all these things that people are looking
macro,
mean big
policies,
changes.
yes,
They mean big
all
changes.
go together.
Yeah, that have implications. And so it's a good time to educate ourselves. Julian, this was so fun. Thank you so much
it was
for
lovely,
coming on.
Maggie.
Great way to end the week with you. And you were behaved. You didn't, you're cursing.
One F-bomb.
Yeah,
I was trying not to.
I'm known
I
for
used to
them
have a
too.
client who used to run a book, actually, when I used to present. I used to be the last speaker, kind of on a Friday at 5 o'clock, right, at their conferences. And they used to run a book for charity on how many F-bombs I drop in.
We all have to have a vice, Julian. We all have to have a vice. That was great stuff. Look forward to seeing the new product. We're going to put Julian's link in the description because some of you are asking where you can find out more. Oh, Paul saying, where are we all meeting for happy hour? Wouldn't it be fun to have a happy hour with Julian? We'll have to try to make that happen for those of you.
Yeah, that would be lovely.
One of these, and then we could really run a book on that. And I might be in on that too,
yeah, exactly.
Who knows if it keeps up like this.
Yeah.
No, it was.
I hope it doesn't get, my ex and I used to comment that during the global financial crisis, it was really bad when we drank, and we were both in the markets, right? She was in asset-backed securitization, so she was right in all the commercial real estate blowing up and all that sort of stuff. And it was bad when we were drinking 2 bottles of wine a night.
Yes, well, actually, maybe this is the opportunity to go into the beverage.
I'm trying to cut down on the booze in time for the wedding next year, but I'm not. I'm trying to lose some weight.
I know. Well, we're all there, but these are trying times. But no, I like ending on the idea that there is opportunity in all of this too.
Yeah, it's huge.
Doomy, but it's not. It's just being prudent.
Yes.
And Akash is drinking wine right now. Cheers. Next time
Lucky
we'll roll
you.
up. Yes. Next time we'll roll up with a beverage too. But we appreciate you all. The chat is off the charts today. You guys are just the best. Thank you so much, everybody. It's been a long week. Enjoy yourselves over the weekend. That rest of the 52% who said you weren't sure, get on it. Get going. It started.
Have some wine. It'll be much better.
Have some wine or spirit of your choice.
Yes.
We've got a lot of good recommendations for that as well in the chat. You can hit up Christopher for that. We were just talking about people in the business too. If any of my female viewers are in growth equity out there, message me. I have to have a conversation with you. I'm asking for a friend and an opportunity. So let me know. Or if any of you know a female that's in growth equity, let me know. Job placements too. We got it all. Julian, have a great weekend. We'll see you soon. Have a great weekend, everyone. Take care and good luck out there.
Thanks, Maggie.